The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Jay Powell getting ready to speak.
Yeah, we are here in New York, but we have our eyes right now on Dallas, where the Fed chair is scheduled to speak in just a moment. Also, of course, have our eyes on Boston, where our very own Michael McKee is monitoring the situation.
And we're going to go over to him right now. Michael McKee, we do have some headlines coming out on what Jay Powell is expected to say when he gives the speech. Give us the broad brushstrokes of what his message will be.
Well, in his advance text, the chairman says that the economy is in good shape and that the Fed is keeping an eye on inflation and the labor market and continues to lower interest rates. Basically the same thing he told us at his news conference last week. It's not a very long speech, but he makes 2 points, one of which might be relevant to the numbers we got the last 2 days on inflation, with CPI and PPI coming in a little hotter than anticipated. The chair says, we expect that these rates, talking about the inflation rates, will continue to fluctuate in their recent ranges. We are watching carefully to make sure that they do, however, just as we are closely tracking the gradual decline in housing services inflation, which has yet to fully normalize. Inflation is running much closer to our 2% longer run goal, but is not there yet. Now, Powell does say that the Fed is going to continue to try to lower interest rates, normalize interest rates, but makes it clear they're not on any kind of preset path, saying the economy is not sending any signals that we need to be in a hurry to lower rates. The strength we are currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve. In other words, we may have had some inflation concerns that raise questions about whether they will cut rates in December, but the Fed's not ready to make that decision yet.
I'm curious here when we talk about that bumpy path, Mike, not only the words that, of course, Jay Powell himself is using, but we heard from Neil Kashkari the other day here on Bloomberg Television expressing similar sentiment. I know you have a conversation coming up a little bit later as well with other key Fed members here. It's one thing for the path to be bumpy, Mike, but when we talk about the commitment they have to fighting inflation and making sure that it stays tamped down, do you think that they're going to offer any more visibility into whether their response is going to be just as bumpy?
Well, we're going to have to see what Jay Powell says in the Q&A and what other Fed officials say going forward. But basically, the members of the committee that we have heard from say there's no change in the way they're going to conduct policy. They're going to continue to watch the data and make sure that they are doing the right thing, whether they need to cut faster or slow down. The issue is now, apparently, whether they slow down because inflation's a little bit higher and because there's a lot of uncertainty about what Donald Trump's economic policies will do. But they don't want to give anything away at the moment. And we do have a lot of data between now and the December 18th Fed meeting.
Yeah, we thought we were all going to be fixating on the labor side of the Fed's dual mandate, but of course inflation remains a persistent concern here. When it comes to the labor market, Powell's saying that the labor market has cooled but remains solid. I mean, we're not looking at the latest jobs report, the October jobs report, as any kind of indication, given that there was so much noise, right?
Correct. And Powell goes out of his way to say that that was influenced by hurricanes, and they know that the data may be a little bit noisy for October, so they're not going to worry about that too much. He talks about other labor market indicators suggesting that the labor market remains tight, has loosened up some, but is not at this point in any danger. It's not going to fall off a cliff. So the Fed is, as he puts it, well positioned to deal with anything that comes up.
So this gets us to the question, Mike, that when we start to talk about the path forward for rates and more importantly, the path forward for the economy, are those individual data points that we're going to get between now and the December meeting and, of course, the first meeting in January, is that going to matter as much as the potential policy changes that might be coming out of the White House and Congress post January 20th?
Well, it'll matter much more for the December meeting, the numbers that we get. We're going to get another CPI, a PCE report, a couple of retail sales reports, including one tomorrow morning, and then we get the jobs report on December 6th. And all of that will factor into their decision making because it's where the economy is now. And then, as I've been saying to people, all forecasts are valid until January 20th. Part of the problem is we don't know exactly what the president-elect is going to propose because he's put out slogans but not details, and we don't know how fast he's going to do it. He's talked about implementing tariffs on day one. Until they get the details, the Fed is not going to be able to model what's going to happen. They certainly will discuss what they think might happen, but they're not going to really talk to us about it. So it's hard to say. January 29th is the next meeting after the December meeting. We'll see if that brings, if by that time we have any better idea of what's going to happen with the economy.
Right. I mean, it all comes down to personnel when it comes to what policies the new president is going to be enacting. So to that end, we are still waiting for Donald Trump to make his announcement on Treasury Secretary, or at least who he's thinking of nominating. We already have some reports of some folks on the short list, pretty familiar names to those on Wall Street. How much of that will drive how people view his efficiency in enacting some of those policies he's outlined during the campaign?
Well, the interesting thing is he's basically named his national security team, and Marco Rubio gets high marks as a potential Secretary of State, someone who has experienced and has a background in it. The others, not so much. So the question is, does he bring in somebody to Treasury with a lot of Wall Street credibility and the ability to sell things to the financial world? Now, the two names you hear most often, Howard Lutnick and Scott Bessent, both bring that to the table. So if he names either one of those, they are probably going to get a respectful hearing on Wall Street. But we're also waiting to see who he appoints as Labor Secretary, Commerce Secretary, and head of the National Economic Council. Those will all be important. And if Robert Lighthizer is officially named U.S. Trade Representative, we know where he's coming from the first round of the Trump administration.
Yeah, certainly so. In fact, kind of weird to actually hear his name, Mike, with regards to Lighthizer actually being bandied about for Treasury Secretary. I do want to stay on the Treasury Secretary pick here, because there does have to be some degree of symbiosis, some degree of a relationship between the Fed and the Treasury. Obviously, independent agencies, if you will, but certainly they have to work in tandem with regards to a lot of policies and, more importantly, issuance of debt and money. What type of relationship would a Scott Bessent, what type of relationship would a Lighthizer, what type of relationship would a Lutnick, for that matter, have with Jay Powell?
Well, I would imagine Bessent and Lutnick would probably have a little bit better relationship with Powell than Lighthizer, just because of Lighthizer's background in the initial Trump administration, and he certainly is very fond of tariffs, which the Fed would not be. But Bessent and Lutnick have long histories on Wall Street, as did Jay Powell. So the three of them could get along just fine. The question is, each administration kind of sets its own relationship up with the Fed chair. Some have had weekly meetings between the Treasury Secretary and the Fed chair. Others not meet so often, not talk to each other all that much. And so it's kind of going to depend on what the administration wants to do. I'm sure that Chairman Powell would be happy to meet with them whenever they wanted. He has made a real, not just career, but a real effort to stay in touch with everybody on Capitol Hill who wants to meet with him. His calendar is packed with lawmakers meetings, so I'm sure he would also want to meet with the administration.
A question for you, and maybe you can't answer it, Mike, but there have been some reports, including from Bloomberg and the Wall Street Journal, about the idea of kind of a shadow Fed chair, if you will. I'm not exactly sure what that would entail, but the reporting seems to suggest that it would basically be more of an informal role, but certainly one with a little bit more direct oversight coming straight from the White House.
Well, this was an idea that was floated by Scott Bessent originally, and now Bessent has backed off it because people told him it wasn't a great idea. But the theory is that Trump could not nominate, but name somebody he was going to nominate as the Fed chair to take over when Jay Powell's term ends in 2026. And then that person would comment on economic developments and monetary policy during this interregnum while Powell is still the chairman. And of course, that would confuse Wall Street. That would create a lot of noise and dissonance for investors. And so I think Bessent and others have been talked out of that for now.
And Scarlett, I just want to point out before you move on to your next question here, I mean, we are seeing an intensification of the sell-off in markets here as we kick you off to the close. The S&P 500 took an interesting leg down. I'm not quite clear if that's on the back of the comments from the prepared comments from Powell, but it's now down about 0.5%. The Russell down more than 1% on the day. All the major indices right now, Scarlett, at or near session lows.
And this might be because Powell sounds a little bit less dovish than what investors had hoped, the market had hoped, with him saying, at least according to the prepared remarks, that inflation is heading towards 2% on a sometimes bumpy path, and that the economy is not signaling a need for the Federal Reserve to hurry rate cuts. And just a reminder again, we are awaiting Jay Powell to take the lectern to speak on the economic outlook at the Dallas Fed in Dallas. And in fact, I get word now from our producer that he is coming out right now. So let's take you now to Dallas, to the music hall. Nope, actually, pardon me, he hasn't come out just yet. But Mike, getting back to that idea that Jay Powell's term doesn't end until the end of 2026. Pardon me. Okay, we're going over now to Dallas. Let's listen in to Jay Powell.
To the Dallas Regional Chamber for the kind invitation to be with you today. I have just a few brief comments on the economy and monetary policy before we move to our conversation. So looking back, the U.S. economy has weathered a global pandemic in its aftermath and is now back to a good place. The economy has made significant progress toward our dual mandate goals of maximum employment and stable prices. The labor market remains in solid condition. Inflation has eased substantially from its peak, and we believe it is on a sustainable path to our 2% goal. We are committed to maintaining our economy's strength by returning inflation to our goal while supporting maximum employment. The recent performance of our economy has been remarkably good, by far the best of any major economy in the world. Economic output grew by more than 3% last year and is expanding at a stout 2.5% rate so far this year. Growth in consumer spending has remained strong, supported by increases in disposable income and solid household balance sheets. Business investment in equipment and intangibles has accelerated over the past year. In contrast, activity in the housing sector has been weak. Improving supply conditions have supported this strong performance of the economy. The labor force has expanded rapidly, and productivity has grown faster over the past 5 years than its pace in the two decades before the pandemic, increasing the productive capacity of the economy and allowing rapid economic growth without overheating. The labor market remains in solid condition, having cooled off from the significantly overheated conditions of a couple of years ago, and is now, by many metrics, back to more normal levels that are consistent with our employment mandate. The number of job openings is now just slightly above the number of unemployed Americans seeking work. The rate at which workers quit their jobs is below the pre-pandemic pace after touching historic highs 2 years ago. Wages are still increasing, but at a more sustainable pace, and hiring has slowed from earlier in the year. The most recent jobs report for October reflected significant effects from hurricanes and labor strikes, making it difficult to get a clear signal. Finally, at 4.1%, the unemployment rate is notably higher than a year ago, but has flattened out in recent months and remains historically low. Turning to inflation, the labor market has cooled to the point where it is no longer a source of significant inflationary pressures. This cooling and the substantial improvement in broader supply conditions have brought inflation down significantly over the past 2 years from its mid-2022 peak above 7%. Progress on inflation has been broad-based. Estimates based on the Consumer Price Index and other data released this week indicate that total PCE prices rose 2.3% over the 12 months ending in October, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Core measures of goods and services inflation, excluding housing, fell rapidly over the past 2 years and have returned to rates closer to those consistent with our goals. We expect that these rates will continue to fluctuate in their recent ranges, and we're watching carefully to be sure that they do, however, just as we are closely tracking the gradual decline in housing services inflation, which has yet to fully normalize. Inflation is running much closer to our 2% goal, but it's not there yet, and we are committed to finishing the job. With labor market conditions in rough balance and inflation expectations well anchored, I expect inflation to continue to come down toward our 2% objective, albeit on a sometimes bumpy path. Given progress toward our inflation goal and the cooling of labor market conditions, last week my Federal Open Market Committee colleagues and I took another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained with inflation moving sustainably down to 2%. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks to both sides. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. We're moving policy over time to a more normal setting, but the path for getting there is not preset. In considering additional adjustments to the target range for the federal funds rate, we will carefully assess incoming data, the evolving outlook, and the balance of risks. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve. We remain resolute in our commitment to the dual mandate given to us by Congress: maximum employment and price stability. Our aim has been to return inflation to our objective without the kind of painful rise in unemployment that has often accompanied past efforts to bring down high inflation. That would be a highly desirable result for the communities, families, and businesses we serve. While the task is not complete, we've made a good deal of progress toward that outcome. Thank you very much, and I look forward to our discussion.
Thank you, Chair Powell, for those remarks.
All right. We were just listening there to the chair of the U.S. Federal Reserve, Jay Powell, speaking at an event down in Dallas, laying out his expectations for the global economy. Of course, he did talk a lot about what was going on here with regards to interest rates and some of the policy decisions that the Fed will have to make going forward. He's now taking questions from the audience at that event. Let's go back down to Dallas.
I'm wondering if you could just explain in general why there is this bromide about it's important for the central bank to be politically independent.
Sure, I'd be glad to. Let me say what we mean by independence first. So what that really means is that the decisions that we make about monetary policy, about interest rates, cannot be reversed by any other part of the government except, of course, Congress. Congress created the Federal Reserve by statute and can do what it wishes to do by statute, but our decisions are not reviewable by any other agency. And we are charged to make those decisions with regard to the medium and longer term well-being of the public that we serve. So we're not thinking as we make our decisions about the well-being of any political party or anything like that. So we're just looking at the macroeconomics and doing the very best we can. There's been a lot of research about central bank independence, and what it shows is that central banks who are independent, meaning independent from the other parts of the government, do a better job on inflation. And that makes a lot of sense because, we're thinking really just of getting inflation under control while keeping the labor market strong, and we're not thinking of political factors, which would frankly be a distraction to the already difficult work that we have to do the main job. So the academic research is very clear globally, by the way. This has been a global trend for more than the past 50 years. Advanced economies like the United States economy around the world all have central bank independence of one part or another, in one form or another. The other thing I'll add is that what comes with that on our part is an obligation to be highly transparent about what we do, to explain ourselves to the public, to Congress. Congress has oversight over the Federal Reserve in our system. So we spend a great deal of time talking to the oversight committees and the broader Congress in the House and the Senate, explaining to them why we're doing what we're doing. I testify as a matter of statute 2 times of the year in each of the House and Senate. So that kind of gives us the accountability that we need to be democratically legitimate in a situation where we do have some independence.
The macroeconomic conditions that you just described in your remarks sound tantalizingly close to a soft landing. I know you're not willing to declare victory yet. To what extent do you think the fact that the Federal Reserve is credibly independent is responsible for the good outcomes that we've had so far?
So the credibility is really everything in our work. And I think, as you know, inflation spiked really globally, all around the world, as the economies around the world reopened after the pandemic shut down, and on the back of a lot of fiscal and monetary stimulus. We saw a burst of inflation all around the world. And what happened is we raised interest rates to bring that down, but the public had faith. We measure inflation expectations many different ways, surveys and based on market-based instruments, and they all kind of showed the same thing, which is the public all through all this believed that we would get inflation down, that we would restore price stability, which we define as 2% inflation. And that's ultimately the key to it. Inflation is a social phenomenon. If people believe that inflation will be higher, then it probably will be. And if they believe that inflation will come down, then people who make and take prices and wages, they will make sure that it does come down. So it's absolutely critical that we be credible. And part of that is that we responded so forcefully when it became clear that inflation needed a response from us. We responded quite forcefully, and we think that helped keep inflation expectations anchored, as we say.
And then one last question, and then we can move on, I promise, on this. There have been times in U.S. history when people look back and say that the Fed was not seen as terribly independent. What did we learn from those episodes, in your view?
Well, if you go back to the period of the high inflation, which I'm old enough to remember, it was during my college years, and basically the public kind of lost faith that the Fed would restore price stability, and the cost was a decade of very high and very volatile inflation, quite difficult business conditions, extremely difficult for people on a fixed income. Think what that does. You may have felt it. If you're on a fixed income and prices go up 20%, you're just in trouble right away. So inflation is worst for people at the lower end of the income spectrum and wealth spectrum. So we've seen it here in the United States in the 1970s, actually, and it's not a pretty picture. So, I think this is very widely, by the way, understood and supported. I've spent a lot of time on Capitol Hill, and I think where it really matters on both sides of Capitol Hill, the Senate and the House, in both political parties, there's a broad understanding that an independent central bank is very important in just serving the public as best we can. We're not perfect. Everyone makes mistakes, but you'll get the best results if you have people who are just focused on that task and separate from politics.
Thanks. A little bit more elaboration from what we heard last week at the press conference on this question. In that press conference, you basically downplayed the impact of the election on FOMC policy. You said we needed to kind of wait and see. But that does stand in contrast to how the FOMC behaved at the December 2016 meeting, when roughly half of committee participants, according to the transcripts, upgraded their economic forecasts based on expected changes to fiscal policy under a Trump administration, and in particular a previous trifecta in which the Republicans controlled both chambers of Congress and the White House. You were, in fact, one of the policymakers who made changes to your forecast, finding that the staff's assumptions around a tax cut was a reasonable placeholder, which gave you greater confidence in the outlook. Does that approach seem reasonable in the current circumstances? That basically, since the FOMC has been starting to judge some downside risks to the growth outlook, does the election and the results that we have today remove or at least substantially mitigate downside risks to growth?
So that's your question? So I think it's too early to reach judgments here, and I'll tell you why. So the job of staff is to go, and be very nimble and make assessments in real time, much like capital markets do. The markets are pricing in assessments of what policy changes will be made and what their effect on the economy will be. And staff will do all of that. I think policymakers are going to wait longer to see what the actual effects will be. And so, for sure, at our December meeting, staff will present what we know. But the thing is, we don't actually really know what policies will be put in place. We know that policies in several areas will change. We don't know how much. We don't know over what time frame. When it comes to fiscal policy, it takes quite a long time to get a bill through Congress. And I think this year, what we're looking at is something that doesn't need to get done until the end of the year, and therefore probably won't have any economic effects this year, but it'll be more 25. It'll be 26 or 27. So I think we have time to make assessments about what the net effects of policy changes will be on the economy before we react with policy. That's not to say we won't be doing quite a lot of analysis. And the analysis we do, by the way, is informed by the best research, the best thinking, the best experts, and there's a lot of research on the effect of policy changes on the economy. We'll make those assessments, but I think we'll be careful about changing policy until we have a lot more certainty.
You've spoken before about federal debt as being at unsustainable levels and the potential consequences for growth. Do we get to a point where deficits and debt get so high that it makes your job harder, essentially, that it makes it harder for the Fed to achieve its goals?
So we're not at that point now. I want to be clear that we're not in any way taking into account fiscal issues when we make our, let me say it this way, the debt issue is not an issue that is guiding us in making our economic judgments. Fiscal policy can, of course, affect the economy. First of all, we do not have a role of supervising the elected branches that do fiscal policy. In fact, it's the other way around. So we don't give them specific advice. But as I have often said, and as all of my predecessors have noted, the U.S. federal government budget is on an unsustainable path. It's not that the debt we have is at an unsustainable level. It's not. It's that we're on a path that's not going to be sustainable. We have a very large deficit at a time when we're at full employment, and I would just say we know that we're going to need to address that, and it's going to need to be done sooner or later, and sooner is better than later. But I leave it at that.
Okay. In addition to the potential long-term risks that higher deficits and debt present for growth, are there also risks to the functionality of the Treasury market? When shocks hit the market? And if so, how might the Fed respond?
Well, the functioning of the Treasury market is incredibly important, and it does function very well. It's the most liquid and most important, probably, financial market in the world, certainly one of the most important. And we did see some, at the beginning of the pandemic, you may remember that the Treasury market lost function because normally in an emergency, money flies into the Treasury market, but the pandemic was such an unusual event. People didn't want to own longer-term securities. They only wanted to own effectively cash, and so we had to jump in and support that. I think more broadly than that, it's just important that the Treasury market remain well regulated, and that companies have an incentive to do intermediation in the Treasury market. It's relatively low risk. It's very important for the economy, and it's important that be the case.
In the March 2020 episode that you're referring to, the Fed ultimately had to step in as a lender of last resort. Would the Fed do that if there were similar disruptions in the initial issuance of Treasuries? That was in the secondary market, as I recall.
We're not a fiscal actor, so that was a situation where we have a mandate that we share with other agencies to look after the financial stability, and part of that is if really important markets break down, and they kind of all broke down at the beginning of the pandemic. They just stopped working, and so we set up a series of facilities to backstop those markets, but they actually didn't get used because just the fact that we had the facilities restored credibility, and the markets started working on their own. It was remarkable. So in the case of a financial stability event like that, or the global financial crisis where really the whole global financial system was at risk given the failure of a number of large financial institutions around the world. In those kinds of things, we can use these emergency tools, but they're not for every event. They're really for financial stability events.
You mentioned that it's a little bit too early to know what policy beyond the remit of the Fed would look like. We don't know exactly what the fiscal picture will look like, but we do know directionally that tariffs are likely to go up, right? Even if we don't know how much, if we don't know necessarily if it'll be exactly what was described on the campaign. And I'm wondering how you're thinking about that. Well, go on, sorry.
So what matters for us is we don't stand in judgment over these policies in any way. What matters for us is to what extent will new policies have an effect on our mandate goals of maximum employment and price stability, and do we need to change our policy because of these changes in order to achieve those goals? And the answer to that question is not obvious. So let's say that there will be some tariffs. We have no idea what that's going to look like. That's one thing. Another thing is, what about retaliation? That changes the picture. In addition, that's happening at a time when there could be fiscal policy, which could be supportive of the economy. So what's really the net effect? We don't take one piece of this. We're looking at the whole economy. In addition, remember, this is way over a $20 trillion economy. Many, many things affect the economy all the time. It's not that common that changes in government policy have immediate effects in the achievement of our goals. That could be the case, and of course we will use our tools as we're supposed to do to foster the achievement of maximum employment and price stability. That's what we do. That's what we always do, and we'll do it here. I'm just saying we're going to be careful to wait and better understand the net effects of these things as those things affect the achievement of our goals.
If you look back to the previous round of trade wars under Trump's first term, the Fed staff prepared a report in the 2018 Teal Book where they basically talked about whether the Fed should be looking through any price increases that result from tariffs and assume that it's a one-time step up in prices as opposed to self-perpetuating inflation or not. And the staff said at the time that the Fed should look through the tariff increases so long as, one, you think it's going to be a one-time adjustment and not a series of adjustments, and two, so long as inflation expectations are anchored. It's not obvious that either of those conditions will hold the next time around, right? Back in 2018, we had decades of very low inflation. Now we've had a much more recent experience with higher inflation. And as you point out, there could be a series of retaliations and tariffs and counter tariffs and counter tariffs. So are the risks bigger this time that a price shock could feed into trend inflation?
They're different. We're in a different situation. The debt situation has changed substantially. And you're right, we're not, 6 years ago and such, the inflation was really low and inflation expectations were low. Now we've come way back down, but we're not back where we were. It's a different situation. Inflation's still running above 2%. But we'll take all of that into account. I tell you, though, the answer isn't obvious until we see the actual policies, and even then it's not obvious. So I just think we reserve judgment until we actually know what we're talking about. And I don't want to speculate. I don't want to guess. I think it's more important that we wait and see what actually happens.
Last time around, as you suggested, there were mixed consequences. There were mixed effects. And as I recall, during these previous trade wars, the Fed actually cut rates several times because there were consequences for growth and investment and confidence. So how does the Fed respond if higher tariffs result in both higher prices and slower growth? Do you have the tools to respond to that? Well,
so you're absolutely right. So in 2000 and I guess it was 19, we cut rates 3 times, and that was right after there had been fiscal stimulus, there had been tariffs, and so it really was because the net effect of what was happening and what was happening around the world too. There was global growth was really soft. there was a feeling that the U.S. economy was softening. We actually cut rates 3 times, I guess beginning mid-year. And that kind of worked, that restored confidence. We felt at the end of 2019, we felt like that had really worked, and that situation was quite a good one. Of course, then the pandemic arrived, and none of it mattered. So that's the way it happened. But that's exactly my point, though. We had a meeting the prior December, and it briefed us on what might happen. But what actually happened was something quite different. So and I'm not talking about the pandemic. I just mean the way that played out. I don't think we started that year thinking that it would be appropriate to cut rates 3 times. So just know that we will do what we believe is the right thing. That's what we're always going to do. But I think it's really important to reserve judgment and see how this plays out. We're still months away from a new administration, let alone knowing the real details of what's going to happen, and then being able to project what will be the net effects on the economy.
Another major factor in the economy in the past year or so, you've said, is immigration. That immigration is a strong reason why supply and demand have gotten closer into alignment. In the past few months, we've already seen big decreases in immigration. What effect do you think that is likely to have on the macroeconomy in the near term?
So before I answer that, I do want to say that immigration is a question to be addressed by political authorities using such values as they deem appropriate. We're looking at the macroeconomic effects and reporting on them. It's not a question of judging. We don't have a view on the right level of immigration. That is for the voting public and their elected representatives. Okay. But what we saw over 2023 and 24 was a surge in immigration, and also a surge in the labor force, and it certainly pushed up economic growth, and it may or may not have had some effect on getting the labor market back into balance. It'll take time to really understand that, but it certainly made for a bigger economy. And, we're coming off the back of a severe labor shortage. So there was room at that time for people to get work. And they went to work at roughly the same level as non-immigrants went to work. So that happened. Then the rules changed. The current administration, the Biden administration, changed the rules a few months back, and we've seen that come down. These are judgments that get to be made by elected people about what the right thing for the country as a whole is, not by us. But you ask what the effects will be, you will see, really there have been 2 supply side things that have been pushing up U.S. potential output and actual output. One of them is just more workers, and the other one is productivity. And the more workers part of it is probably diminishing in its effects. And so that won't be something that's pushing up overall output. At the same time, the number of job openings has come way down, so it's not clear what the overall effect will be on there's about 1 job opening for every unemployed person now. In terms of productivity is incredibly important. That's just output per hour. And if you think about it, higher output per hour is really the only way for incomes to go up over time among the public. And we've actually had, for the first time in a while, a few years of higher productivity, going back 5 years now. This is incredibly important and very positive, and we hope it continues. And there's no reason why it can't. I will say, though, that over the past 50 years, if you look at it, if you have 1 or 2 or 3 years of high productivity, it tends to revert to the trend really quickly. Because it tends to be driven by longer run things like evolving technology and evolving educational levels and things like that. So you don't tend to get big increases of productivity that are sustained very often. It's quite rare, although it has happened.
I do want to ask you some more questions about productivity, but just one follow-up on the immigration point. And
we're listening right now to Fed Chair Jay Powell speaking at an event in Dallas, Texas, a wide-ranging interview that was preceded by some prepared remarks largely hewing to the lines that we've heard from the Fed in the past. Romaine Bostick here alongside Scarlett Fu, counting you down to the closing bells. And Scarlett, we talk about the questions that were asked, and quite frankly, a lot of questions that were unanswered. But there was an immediate knee-jerk reaction that we saw coming out of this. The idea here that he made it clear that based on his view of economic conditions, no real rush to cut rates. And we saw that reflected in the swaps market. A swaps market that yesterday was pricing in an 80% chance we were going to get a Fed rate cut in December. Now, as of right now, that's down to about 60% odds. We saw a spike in 2-year Treasury yields, a drop in the S&P, as well as a NASDAQ, and a modest bump in the dollar.
Yeah, all along yesterday, we were looking at basically one 25 basis point rate cut between December and January. And now December is looking less and less certain. Of course, Jay Powell making clear that the Fed has room to kind of see how things progress.
Absolutely. Here, our very own economics and policy correspondent, Michael McKee, is standing by. He is in Boston right now, but I'm sure he was listening intently to everything Jay Powell had to say. He basically made it clear that he thought the Fed responded forcefully to inflation. They fought that fight, and they anchored expectations. But as far as what comes next, Mike, did we learn anything?
We didn't learn a whole lot. He did leave the door open to a pause in December, and that's what the market's reacting to. But I wouldn't put too much on that right now because we have a lot of data, including another CPI report, jobs report coming up before the next Fed meeting. So we'll see the odds of a Fed move around quite a bit. The questioning was sort of framed around the Donald Trump administration, the incoming administration, and what they might do. And as you noted, he didn't really give us specific answers. Catherine Rampell from the Washington Post asked him about Fed independence, and he made the usual case that the Fed needs credibility on Wall Street. They need investors to believe that the Fed will do what its job is and what it says it will do. And that's why an independent central bank is important. She asked him about tariffs, and he said, we don't know what the tariffs are going to be, so we can't really tell you what our response will be until we do know. He said, suppose we get tariffs. We don't know the level of tariffs, and we could also see retaliation from other countries that would make a big difference, and we might also see some fiscal stimulus. So we're going to have to wait and see. And then finally, you just heard the answer there on immigration. It's not up to the Fed to decide who comes into the country. They just have to deal with the labor force that they have. The Biden administration has cut the labor force down. That affects productivity. But productivity on the other side has been strong as well. So it comes back again to the idea that the economy is still in pretty good shape.
There was a question about the debt, the national debt and how that's grown and how that's a long-term concern, certainly for some in the bond market. And he did say that the federal debt is on an unsustainable path, but then talked a little bit about how that's not exactly a guide in terms of how the Fed pursues its policy.
Right. He said that the national debt's on an unsustainable path, but it is not at an unsustainable level. We can sustain this level of debt. And we have, because growth has been strong enough to make up for it. And as long as that's the case, the Fed and the rest of the economy doesn't have to worry, but they do need to change the path at some point. Again, then he backs off and says, but it's not our job to tell you how to do that. One other thing that he was asked about was the Treasury market and how that might be affected by what Donald Trump and what the national debt situation is going to be. And he said if there were a shock to the Treasury market that was a financial stability question, the Fed has the tools to react. But he said we're not going to get involved in just day-to-day trading issues.
All right, Mike McKee, really appreciate your taking the time to give us the instant analysis here on Jay Powell's conversation taking place in Dallas right now. And if you want to continue to check that out, you can hit Live Go on your Bloomberg terminal.
I just want to bring your attention real quick, Scarlett, to what's been going on in the markets, particularly when it comes to healthcare stocks here. A big leg down for some big names like Pfizer, like Lilly, like Moderna, as well as Novavax. This is largely on the back of a report from Politico that is saying that President-elect Donald Trump is expected to nominate Robert F. Kennedy Jr. to lead the Department of Health and Human Services here. Obviously, some concerns here about his stance on vaccines. All of the vaccine makers now taking a large leg down, Scarlett. And this now we start to talk about the real ramifications of policy decisions here. This is a market that Trump is very in tune with. We saw that during his first term. He pays very close attention to how stocks go, and I wonder if the way to communicate with this administration is through price action.
Well, maybe. We'll see if the selling continues and whether that actually elicits a reaction from the president-elect. In the meantime, we want to move forward with, what his policies mean overall for the broader economy and
Yeah.
for company executives who have to make a lot of decisions in the coming weeks.
Yeah, and it's going to be, look, it's going to be a challenge. I mean, look, anytime you're doing a CEO, you talk about this idea of just how complicated that job is. You're not just managing employees, but you're managing to a certain extent your customers and clients, and obviously you're managing the folks in Washington, whether it's in the White House, Congress, or everything in between, and then you have all the state and local governments. So it's a tough job, right?
Yeah.
And we know it's about to get a lot tougher given Trump's, way of managing things, but that's what you got to live with, right?
Yeah.
And you think about the CEOs who did do a great job, or at least got credit for doing a great job during the first 4 years, finding the right way to navigate and thread that needle.
Yeah, and they have the experience of being able to draw on what happened the first time, and a lot of the times it's just making sure that you're in constant communication with the administration.
And that is a big thing here. Let's check in on the broader market, Scarlett. Here again, we are right around session lows here for most of the major indices on the day, 0.6% on the S&P. But once again, I'm still kind of intrigued by the sell-off that we continue to see in the small cap space. The SML, the S&P 600.
That was short-lived, wasn't it?
Yeah, I mean, they had that big rally. It was like 8-9% last week on the back of the election, and giving back about 3 to 4% of that since. Similar story for the Russell 2000.
And maybe it's a case of waiting for some evidence that a new administration will be good news for them. Maybe seeing it in their sales prospects, for instance.
Absolutely.
Which we not necessarily have gotten yet. All right, let's move on here, because the U.S. was battered by back-to-back hurricanes last month that caused massive disruptions in the global supply chain. And all this happening as President-elect Trump is set to take office in just a few weeks, creating yet another shakeup for companies with his plans to raise tariffs. Joining us now is someone who can speak to both of these topics. He is Joe Hinrichs, and he is President and CEO of CSX, which is a leading supplier of rail-based freight transportation in North America, the biggest on the East Coast here. Welcome. Good to see you, Joe.
Thank you. Thanks for having me.
So I want to start big picture here, because the U.S. will see a changing government in January, and with it, of course, new trade policies and new regulatory policies. What is the single biggest change that you anticipate for CSX and the rail industry?
Well, I think from our standpoint, the best thing the government can do is help the economy grow, because we move goods. So obviously, movement of goods is part of the economic growth. But one thing that we're looking for actually is a regulatory environment that is supportive of that growth, especially when it comes to safety and service. And so, that's one thing that we'll be talking about a lot as the new administration comes in, is how do we work together to foster economic growth, because we're a big part of that, the engine of that, but also how can we have a regulatory environment that works together to make it safer, but also make it better for the economy.
Now, it's still unclear the extent of tariffs that the incoming White House will impose, but do tariffs direct CSX directly? I mean, do they affect you directly? You move whatever goods consumers buy, whether it's imported or whether it's made in the U.S.
That's right. So actually, it does affect us on the imported goods that come into the ports, potentially. But at the same time, if more things are made in America, it's actually good for our business. And especially because we're the strongest in the Southeast and the Midwest, that's where a lot of the new development is happening, industrial growth. We're a big part of that. We have over 500 projects going on right now in the United States in our network that's going to be on our rail network that's growing new business and new investment. So for us, you're right. If the economy is growing, whether it's internal or external, we're going to move it. But in actuality, if more stuff is made in America, it helps our business even more.
I am curious about labor dynamics. I mean, we came out of a year where we saw probably some of the biggest groundswell of labor strikes, at least in my lifetime here. And I know some of that's been tamped down. You had some experience in dealing with unions when you were at Ford. Dealing with railroad unions is a totally different animal. I think at Ford, you probably dealt with, what, one union, maybe two?
Yes.
How many are you dealing with now at CSX?
There's 13 major unions in the rail network in the U.S. alone.
Yeah.
Like you said, in the auto industry, it was just the UAW in the U.S. and Unifor in Canada.
And what's your relationship like with the unions?
Well, I think we're very much improving, but historically we've had a difficult relationship. If you go back to the 1800s, the railroads had a difficult relationship with employees, for centuries, and we're trying to change that. And our view is the way to change that is to try and find a more collaborative approach to negotiating. And you may recall 2 years ago we were at Congress and the Presidential Emergency Board had solved the last round of bargaining, which took 3 years.
Yeah.
And this time we've come to a conclusion with more than half our workforce and 11 of the 13 unions to find tentative agreements before the contract expires, which never happened before.
Ahead of deadline.
In the rail industry, yes. Because we think that in order to change the relationship with our employees and change the culture of our business, we have to get in front of this so that we're not fighting over it, so that we can spend the next 5 years working together to serve customers better and work and resolve employee issues as well.
A big part of that, though, too, in addition to improving the relationship there, is also this sort of balance between the human labor and technology, which some people see as a threat. But in the rail industry, I think it's very acute, right? Because a lot of people would say, and you could correct me if I'm wrong, the technology in the rail industry is probably behind the times. And not just about CSX, that's really on the whole broad supply chain here. How do you find that balance? How are you going to find that balance?
You know, it's interesting because in the auto industry that I spent 31 years in, you know, we had to keep evolving with technology to compete globally. The rail industry hasn't had to do that as much. And so we've also had this tension between the unions and the administrators and regulators and the companies to try and advance technology. And if it had a threat of labor involvement, it kind of tended to stall.
Right.
And I have this theory that, you know, over time, technology is undefeated. So you can't fight it forever.
Yeah.
You have to embrace it. But how do we embrace it in a way that's good for our employees, better for the communities that we serve, for safety and otherwise? And how do we do that in a way together? And I think we approached it in the past as a combative type thing. And how do we look for solutions that work for everybody? But we need to advance technology in the rail industry, from everything from our network system and also to the safety of our network.
Is that going to get times back up, I mean, response times? Because that's been the big criticism, too. I mean, we talk about the companies that rely more on trucking. A lot of they do it because they need that just in time. They feel like they can't get it from the railroads. I thought this was something that was supposed to have been addressed years ago. I mean, has the Hunter Harrison playbook, has that been completely thrown out?
Well, I think we're in a next phase now.
Yeah.
I mean, certainly the railroads got a lot more efficient and they're much more profitable and they have more capital to deploy than they ever had before. But now we're in a phase of how do we engage with customers to grow the business, which has to involve our employees. But on the technology front, how do we look for opportunities to focus on safety and service as opposed to necessarily efficiency first? But efficiency will come out of that because in order to serve the customers better, we have to be more efficient. We're a network. It has to flow. And to be able to make that happen, technology can be a big part of it on inspection, also on safety, but also on just the network, the brains, the algorithms that are making decisions for us every day.
But won't technology replace jobs? I mean, that's the crux of the debate at the ports, for instance.
Sure. That is a big debate right now on the ports. Our perspective is let's engage our employees in fixing the problems that technology can help us find better and more proactively.
Using technology to find the problems.
Let our employees fix the problems, whether it's a car, whether it's the inspection of a car, whether it's the rail. We need employees to be a part of that. We want employees to be a part of that. It's where we channel their energy. Can we use technology to more accurately and precisely identify problems and then use the people to solve them?
With technology, do you think you need to hire more people, or do you keep staffing it where it is? Because
I think staffing can stay pretty where it is. Is again a redeployment of where people can be utilized.
I see.
For example, we have thousands of cars that need to be fixed every day. Put people on that as opposed to finding the problems that maybe a robot or maybe an inspection can find, or a rail, for example. But importantly, we want to engage with our union workforce to be part of that solution together. Because over time, we want to be more efficient, but we also need to be more safe. But also, we want to serve our customers better because that can allow us to grow. The challenge with the rail network is if we can provide better service, which engages our employees, we can grow, which employs more people and gives them more opportunity.
Any chance that we're going to see any significant M&A in this in the rail industry?
Probably unlikely because we're down to 6 Class 1 rails, 2 in Canada, 2 in the East, 2 in the West. We had the big CPKC merger or acquisition, but probably not anything major that I'm aware of, and I'm not sure the regulators let that happen.
All right, well, it's going to be some new regulators in January, Joe. We got to get you back then and see how you feel then. Joseph Hinrichs is the CSX CEO and president as we continue to count you down to the closing bells here in New York. We're just about 8 minutes away from those bells with stocks right now holding around session lows. We saw an interesting spike in yields just a little while ago, Scarlett. That 2-year yield at one point was up 8 basis points, now up about 5.
Yeah, and all it comes back to what Jay Powell said, which is the Fed is not in any rush to cut rates. The economy is holding its own. And so that removed some of the certainty about a rate cut in December, although there are still odds are still about 50-50.
The price action really interesting today, and we talk about the policy response to a Trump administration. Of course, there has been some very positive responses in the market over the last few days, but a big negative one today with regards to healthcare stocks and the prospects of RFK helming the Health and Human Service Administration here in the U.S.
You think he can get confirmed?
Well, there are a lot of folks on that list that we're going to have to find out whether they're going to get confirmed here. Of course, the market is going to have to adjust one way or the other. Amanda Agati joining us right now, Chief Investment Officer at PNC Asset Management, as we continue to count you down to these closing bells. And Amanda, I do want to start with that Trump trade because, I don't know what's happening today, but we talk about that rally that we saw last week and the euphoria. Whether you like Trump or not, there was a certain euphoria that the environment for stocks and more importantly, the environment for corporations is going to be a little bit more conducive to profitability, to revenue growth, and in turn, of course, market returns.
I think that's absolutely right. I mean, there certainly was an unexpected red wave. I mean, I think some people expected it, but the consensus was certainly not a red wave. And so there was definitely some disconnects or sort of mispricings coming into the election. So we've seen some recalibration here. We've certainly seen a rallying in equities on what appears to be more certainty and clarity, but I would say maybe not so fast. I mean, post-elections, it's always sort of a relief rally because at least we have some certainty. But I think there's an awful lot of unknowns, and I think this equity market rally is pricing in certainty. And so I do think it sets the stage for maybe a few disappointments in the new year.
Well, let's talk about some of that uncertainty. While you were speaking, Amanda, a red headline crossing the Bloomberg terminal, Jay Powell still speaking down in Dallas, now saying, and I quote, "If data lets us go slower, it seems like the right thing to do." Amanda, this has been the big topic of conversation as to whether that big, massive rate cutting cycle that we thought had kicked off a couple of months ago, whether that might be on pause for quite some time, given the slightly stronger than expected economic data we've gotten since.
Yeah, I hope that it's not officially on pause, but I do think there are a lot of arguments to be made to say that we go at a slower than expected pace, and certainly slower than what the market has been expecting. When we look at the economic data, it continues to come in stronger than expected. I'm not convinced that we fully won this inflationary battle. We're gaining on it, but I think things are going to be a little bit choppy as it relates to inflation. We, of course, are going to have some material fiscal policy changes to contend with in the new year. So I think Powell's right to start walking back now and create some forward guidance around maybe things will happen at a bit slower pace than what the market is currently pricing in.
And I just want to point out, too, Scarlett, he also says that he believes policy right now is still restrictive.
Interesting. And again, you're looking at stocks near session lows at the moment, with the S&P now down 0.2%. So, Amanda, given that we have more than a month before the next FOMC decision, and there's going to be a lot of data points between now and then, and very difficult to kind of gauge what the Fed is going to do, with the odds currently at 50-50 for December, what do investors do between now and then?
I think investors need to stay the course and not get too bogged down in the noise between one Fed meeting or another. I mean, you mentioned it earlier. Powell reiterated it. You know, policy is still in a net restrictive place. That first 75 basis points of cuts that we got really helped sort of recalibrate to where financial conditions have already eased to. So they could easily do another 25 basis points and not materially move the needle from a financial conditions perspective. So I think the December meeting and the action there could very well happen. But I think the path in 2025 is going to be a lot tougher to gauge. I don't think we're going to have enough material data points between now and then to change the narrative in terms of inflation.
Well, we have the price action to go by, and the price action in the dollar, for instance, is that it continues to get stronger. It's now up for a fifth or sixth straight day. That is a negative for a lot of the companies in the S&P 500, isn't it?
It certainly is a headwind for many companies. It's something that we watch very closely. So at a time where I would say earnings growth is under pressure, it's not bad. I'll give it at least a C+ in terms of health or grade there in terms of economic growth. It's just another layer of pressure that I don't think we need at this moment. I personally think the movement in the dollar is much more a reflection of potential tariffs and trade policy actions to come. But again, we don't have a lot of clarity. It's really an anticipation of maybe what's to come.
Amanda Agati, PNC Asset Management Group Chief Investment Officer, helping us count down to these closing bells. We are just about less than 3 minutes away from those bells, Scarlett, right around session lows for most of the major indices.
Yeah, it's been a weird day, right? I mean, we had CPI yesterday, PPI today, and it was all day waiting for Jay Powell to speak. And when he did speak, it was kind of like, we're going to wait to see what else happens.
Yeah, absolutely.
Hurry up and wait.
Absolutely here. We talk about 10 of the 11 S&P sectors in the red on the day, but the biggest decliners here are the names that you would think would do well. Industrials down about 1.7%. Scarlett, healthcare stocks took a huge leg down about 1.5%, and discretionary stocks down 1.5% as well. Yeah, and the Russell 2000 leading the way lower, off by 1.4%. So much for that rotation. A slight perk up in the VIX, a slight perk up in short-term yields. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlet Food, taking you through a closing bell, a global simulcast. It starts right now. Carol Massar and Tim Stenovich joining us from the radio booth as we welcome our audiences across all of our platforms, including our partnership with YouTube. A lot to parse today, Carol Massar. At one point, we weren't even sure we were going to talk to you today. It's like, would she, won't she? But I guess you decided to do the simulcast anyway here. Stocks at session lows, yield spiking, Powell speaking, RFK now going to be your new Health and Human Services Secretary.
Got to get it confirmed, doesn't he?
Yeah, a lot going on, Carol. Take your pick.
Listen, what I think is really important is what Jay Powell says. If the data lets us go slower, that's going to be what we do. And you have seen that reflect in the U.S. Treasury trade. Take a look at that 2-year note right now with a yield of 4.34. You've seen kind of a flattening or, out of the belly of the curve here. The expectations in terms of what the Fed does come December, next month. Again, traders paring that back. Mind you, the data keeps kind of kicking us around on all of this.
Look, you guys are focused.
Jay Powell.
You guys rightly focused certainly on what we heard from Jay Powell, rightly focused on the bond market. But Romaine, as you mentioned, Politico reporting earlier, Powell was speaking that RFK, Trump has offered RFK HHS secretary position. As a result, we're seeing shares of vaccine makers take a tumble right now. Shares of Moderna down 5.6%, shares of Pfizer down 2.7%. We'll see what kind of effect this has if he does get confirmed.
Novavax down 7%, and we should point out that the selling really intensifying in those names. Still speculative. Remember, these are reports from Politico and CNN. A formal nomination has not been made, and to a point Scarlett made just a second ago on the TV broadcast, it still has to get through confirmation. A lot of hard questions.
Not just him, a bunch of people as well.
Right?
Yeah, absolutely. And, we should mention as well that the economic data, if the Fed is going to look at the data as its basis for everything, the data has been coming in better than expected, according to the Citi Economic Surprise Index.
Cinemark ringing the closing bell on the NYSE today. Not quite a day to be clapping, but they're required to do so anyway. The Dow Jones Industrial Average down more than 200 points or 0.5%. The S&P and the NASDAQ each down about 0.6% on the day. But the real laggards were in that more industrial and small cap space, if you will. S&P 400 mid caps down about 1%, and the Russell 2000 down 1.4%.
All right, Romaine, and we've got a majority of names in the S&P 500 lower today. 363 names losing ground here, and we also saw that selling steepen on those comments by Jay Powell and the reaction certainly in the Treasury trade. 140 to the upside, and we've got 0 unchanged here, Scarlett.
All right, let's take a look at the sector performances. It's really interesting here today because you've got two sectors that finished barely higher. Energy up by 0.1%, and tech is basically little change at this point. And oil prices moving up slightly, so maybe that's helping support the energy stocks. But the big decliners, industrials losing 1.7%. Healthcare, as we mentioned, with the speculated nomination of RFK Jr. as Health and Human Services Secretary, and consumer discretionary losing 1.5% as well.
Yeah, a fair amount of red in that screen there. All right, let's get to some of the individual gainers. Kind of easy for me. Kind of feel like specific stories keeping these stocks higher in the trade. Tapestry.
Oh, you got Tapestry on there.
I did, just for you. Up 13%. You're welcome. Number one gainer in the S&P 500. Capri Holdings and Tapestry, as you know, scrapping their $8.5 billion plan to merge after court order froze the proposed combination of the companies. That has to do with antitrust regulators' objections. I think we have some breaking news.
Yeah, let's get right to it. Applied Materials crossing the wire. We should point out that the shares had actually risen about 2% in the cash session, now down here in the after hours trade as adjusted EPS coming in at about $2.32 a share for that fourth quarter. That's actually a beat. The street was looking for $2.19, and sales also coming in slightly above estimates, $7.05 billion. We'll round that up to $7.1. Street was basically looking for about $7 billion even here. And we should also point that as far as the semiconductor systems net sales, and this is important because this is the one that more encompasses the potential for that AI bump, relatively in line with estimates, $5.18 billion. Street was looking for $5.13.
All right, and let's give you also the adjusted gross margin, the profitability here, 47.5%. It was about 47.3% last year. This was just slightly above what analysts were anticipating. As for the outlook for this quarter, fiscal first quarter, it sees net sales of anywhere from $6.75 billion to $7.55 billion. Analysts were looking for $7.25 billion overall.
All right, AMAT shares, keep in mind, up 15% here in 2024. Right now, we're looking at about a 2.5% decline here in the aftermarket. All right, back back to some of the individual gainers. Disney, another one that was among the top gainers in the S&P 500, number 3 to be exact. Intraday up the most in nearly 4 years. Walt Disney, you know some of the numbers, posted fiscal fourth quarter sales and profit that beat Wall Street estimates. Forecast earnings growth for the next 3 years, which is not something that this company is known for doing. It hasn't made long-range profit projections. A lot of talk about what was going on in terms of streaming.
Too, particularly given that the guy making that forecast won't actually be around.
Maybe.
To see whether, or at least technically he's not.
Maybe.
Actually, you're talking about Bob Iger?
Yes, I'm talking about Bob
Iger.
Iger.
We asked Geetha, we kind of kidded with her, and we're like, might he stick around? And she's like, maybe. She expects him to go, but she seems to think he's getting certainly the company on track. You're right. A good point. Anyway, third gainer here on this Thursday. Wynn Resorts, guys, just finishing off its highs, up more than 9%. This is after billionaire Tilman Fertitta reported a 9.9% stake in the company in a 13D filing. So certainly some interest in that one on this Thursday.
Okay, I want to go to some decliners. And we had shares of U.S. automakers falling after Reuters reported that President-elect Donald Trump plans to eliminate that $7,500 consumer tax credit for EV purchases. Shares of Rivian fell by 14.3%. According to Reuters, Trump's transition team had been discussing ending the subsidy as part of a broader tax reform effort. They cited unidentified sources with knowledge of the matter. Representative Tesla support ending the credit, according to the report. Once again, shares of Rivian falling by 14.3%. SMCI Supermicrocomputer down for another day, this time 11.4% to the downside. This after the troubled server maker delayed yet another filing as it continues to search for a new accounting firm. Remember, it was just last month that EY resigned. That was the company's auditor. They cited questions about its client's commitment to integrity and ethics. Now there are concerns that it's going to get delisted by NASDAQ and actually booted from the S&P 500 just after being added earlier this year. And Hims & Hers Health, the telemedicine provider, shares fell the most on record today, down 24%, after Amazon said it's launching a competing telehealth platform offering for its Prime members. This would be from One Medical, which Amazon bought in recent years. It offers a clinical visit, treatment plan, and free meds for a range of common health, beauty, and lifestyle concerns.
Let's take a look at what happened in the yield space. A lot of activity on the short end of the curve, selling to be sure, with your 2-year yield. Looks like it's going to close out the day up by about 6.5 basis points. At one point, it was up more than 8 basis points. Now back to its highest level since late January. You saw a similar move on your 5-year yield as well. But we should talk when we go out to the longer end of the curve, that 10, that 20, and 30-year yield. You saw the yields drop there, and that created a bit of a flattening of the curve. But a lot of this activity, of course, came after we got those prepared remarks out of Jay Powell at about 2 p.m. local time out of Dallas. It seemed to suggest, at least in his public comments, the potential for a bit of a slow walk when it comes to any additional rate cuts.
For now, right? But as Mike McKee reminds us, we've got another inflation print, we've got a labor market, we've got a bunch of data before we get to that December meeting.
We've got more than a month before the next meeting. That's a lot of data points.
Nothing can happen. Nothing can happen. Hey, listen, this is something that's happening that we think is just kind of wild. The Onion, along with families of Sandy Hook Elementary School shooting victims, are on tap to buy the right-wing provocateur Alex Jones' InfoWars website, which is kind of wild.
Yeah, this group was chosen as the successful bid for the InfoWars intellectual property. This is according to a court filing. We don't know the price, but a liquidator has been tasked with liquidating Jones' estate in bankruptcy to help him pay down approximately $1.5 billion in defamation judgments related to statements that he made, calling the 2012 Sandy Hook shooting a hoax.
We should point out the advocacy group Everytown for Gun Safety will be the exclusive advertiser for the launch of the site. Everytown for Gun Safety, as we know, is backed by Michael R. Bloomberg, of course, founder of Bloomberg LP and Bloomberg Philanthropies.
All right, wonderful. We're going to turn to something just a little bit lighter here, of course, and it involves Netflix. And of course, Scarlett, I know you were really into this show when it came out, when it debuted, Squid Game. It's coming back next month.
It's coming back one day after Christmas, when Netflix shows its first pro football games. Remember when Netflix said it wouldn't do live sports? Well, it's doing that, and then it's going to hold on to that audience by launching Squid Games, the second season, which, if you watched the first season, I didn't necessarily think there was another second season in there.
Thank you, Scarlett. How do you do another season? I don't want to give away all the details.
Don't give it away. I haven't
seen
it yet, Tim.
Well, let's just say there are some twists and turns.
I haven't watched it either.
Thank you, Carol.
It's pretty good.
You're welcome.
It's really
Some
good.
of us have taste, right, Romaine?
No, this is really good. You guys should watch this.
I am curious. It's funny. There's a great profile of the creator of this, and he kind of talked about all the pressure that was on him when he did the first one. And you see this, like he claimed he lost like 6 or 7 teeth, I guess, from all the stress.
It was very stressful, right? He ground his teeth, I think.
I'm like, what?
So, yeah.
I was like, dude, like,
Dude.
Or maybe
no,
he
no
was
one
playing
needs
some of the
Squid
He
Game to be
wrote,
that
he
bad.
wrote 2 seasons, though. After Netflix talked to him, he wrote 2 seasons.
Yeah, so they
and now
got
he's done.
2025, then he's got another one for 2026, so,
Yep.
or at the end of the 2024, sorry, and then into 2025. There you go.
It's
Carol
okay.
Master. We'll catch up on it together. Carol and I are going to have a viewing party.
Popcorn.
Tim, you're not invited.
It's
Yeah,
fine.
it's the two
I've
of us.
seen it, okay?
Oh,
I don't want
sorry.
to come.
They're so cool, aren't they? All right, that's a wrap. Our cross-platform coverage, guys. Radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow for the closing bell.
All right, we're just getting started here on The Close on Bloomberg Television, a deeper dive into some of those results that we got out of Applied Materials. A lot of focus coming up on the semiconductor industry. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Let's take a look at how markets ended out here on the day, right across the screen for the major indices here in the U.S. What has effectively been a fourth straight day of softness coming off what had been a phenomenal rally last week surrounding the U.S. election. The NASDAQ 100 down 0.7%. Small caps continue to slide back. The S&P 600 down about 1.3% here on the day. And then you talk about some of the other risk assets out there. Bitcoin, which at one point, again, was trading above that 90,000 level in over the past 24 hours, falling about 2% here on the day, back down to around 87,000.
You know, a drop of 1.7% for Bitcoin is like almost like, unchanged at this point, right?
Just a flush one.
All right, let's take a look at some of the big movers on the day. Auto companies as a group dropped about 5%, and here's why. Tesla losing more than 5.5%. Rivian, which is not in the S&P 500, losing about 14%. And this is after Reuters reported that President-elect Donald Trump plans to eliminate the $7,500 consumer tax credit for EV purchases. Tesla reportedly supports ending this credit. And the ETF that tracks healthcare companies in the S&P 500, that's down 1.6% on another report that President-elect Trump will nominate RFK Jr., who's stridently anti-vaccine, as the Health and Human Services Secretary.
Yeah, and it's more than just being anti-vaccine. There's a lot of questions here about the processes that would actually occur under his sort of tutelage. But once again, we should point out, again, these are reports. There have not been formal nominations. And as you pointed out earlier, this still has to get through Senate confirmation. So there'll be a chance for lawmakers to ask some very pointed questions, I'm sure, about his qualifications.
Yeah, he's one of a couple of nominees who will be put under the microscope by the Senate.
We are keeping an eye on Applied Materials. That is one of the big movers in after hours trading. It is down about 4% right now. This, of course, makes a lot of semiconductor making equipment, if you will, here. And the results certainly weren't bad. In their fiscal fourth quarter, the company did beat on both the top and bottom line, $2.32 on an adjusted EPS on the back of about $7 billion in sales, up about 5% from the year ago quarter. Doug Clinton joining us right now. He's a founder and CEO of Intelligent Alpha. And I do want to start off with AMAT, and really in the context and contours, Doug, of what I thought was supposed to be kind of an alternative AI trade. Do you see any of that in this report?
We don't see too much evidence of that right now, Romaine, and certainly the stock action after hours would corroborate that. I think investors right now, if you look at it down 4% in the aftermarket, is really focused on that revenue guidance. So a little bit light relative to next quarter. And I think we've seen this kind of across a lot of these companies that are tangential AI plays, where if you just get something a little bit wrong, if the guide looks a little bit light, you are going to get punished for that. For our money, we use AI to actually make investment decisions. Our AI investment committee prefers more pure play AI names instead of AMAT, companies like a TSM or an NVIDIA right now.
Is there any sort of scenario where the road to AI goes through AMAT in some way, similar to the way we talk about right now? It's all going through NVIDIA. They make a lot of key components. They have a lot of equipment that I think would be useful to the bigger players as well. Do they not benefit?
They certainly do benefit, and I think, one example, right? We've talked about high bandwidth memory. That is one very popular component that these AI chip makers need. Micron, Hinrichs, they're two of the world's biggest makers of those components. AMAT is a supplier that kind of helps create this advanced memory that we use in AI applications. I think the challenge for AMAT, though, is that it just feels like they might be a layer or two removed for the average investor, somebody who's really excited about AI, to understand what they do. And I think just the broader semi-cap space faces that challenge in general. What they do is very complex. What NVIDIA does, look, we make a chip. All the big customers, the hyperscalers, they buy it. I think that's relatively easy for a lot of investors to understand. But actually creating the capital equipment that AMAT does, that ASML does, who had actually some good news earlier today as well, that's a little bit harder of a story to understand, so it doesn't get as much attention.
Yeah, the narrative is not as clear, right? And that's kind of what it comes down to, especially with AI. There has to be a clear narrative. I'm glad you bring up ASML because I think about the disappointing bookings that ASML reported in mid-October that kind of got people worried about this round of earnings for chip-related companies. How is what Applied Materials is saying with regards to its revenue forecast comparable or not to what ASML was telling us?
I think there is some comparables there, Scarlett. And I think what will be really telling is when we get more information from the CEO on the call later tonight, kind of the commentary around AI. And here's how I would guess that that will play out. What we see from a lot of these companies is that the demand for their AI-related products tends to remain very strong. I bet we're going to hear that from AMAT later. But there's other areas of their business. Obviously, AMAT also supplies equipment to companies that make chips for auto. That has been a touch and go story for a while, obviously for PCs and smartphones as well. And so they touch a lot of different segments. I think what we're going to see is that the mosaic of all those segments resulted in the guidance that we have here that investors are focused on, but the commentary around AI will probably be strong. I don't know if that'll be enough for the stock to recover, though.
Right. Unless investors are seeing concrete returns in that investment in AI, they're going to be probably a little bit more cautious. Doug, how are you thinking about the incoming Trump administration and, the protectionist measures it's going to take and the impact on a company like Applied Materials, which doesn't make chips like NVIDIA, and therefore its goods, the product that it makes, is less likely to be under scrutiny as the equipment that it makes?
Well, about 30% of AMAT's revenue comes from China, so they do have significant exposure. And I think there's really two ways that we could see this play out. There is a world where perhaps Chinese companies, in fear of potential tariffs or other restrictions on these semi-cap companies, maybe they start aggressively ordering, in the next quarter or two to try to get ahead of any future regulations. That's a potential scenario that could be even a short-term catalyst. I'm not sure what to put in terms of probabilities on the odds of that, but there is a case that that could happen. Longer term, I do think that given that 30% China exposure, we may see some volatility maybe a year out. By the time we get some of these other controls in place, it might even be beyond a year. But I think that you could see a little bit more volatility in the revenue numbers looking further out.
This gets to this idea, Doug, when we talk about investing in tech, and if you do believe that we are kind of in the middle of what is going to be kind of the next sort of big tech boom, coming out of the internet era and now maybe moving into this AI area. At some point, just like we saw back then, just like we saw in the 70s with regards to the advent of computers, there was always sort of this broadening out of the trade, this idea of new players coming in beyond just the one or two dominant ones here. How do you sort of model for that? How do you sort of seek those out? Are those already public companies? Should we be looking in the private space? Where?
You're reading my mind, Romain, when you mentioned the private space.
Yeah.
I think that in the public space, it's so concentrated right now on the mega cap tech companies, NVIDIA, Google, Meta, the companies that are building the models, obviously. Where we really get excited, and I'm also a partner at Deepwater where we invest in private companies. I think that's where we're ultimately going to see a lot of this trade broaden out, because I think some of these really high quality pure play AI companies in the private markets will come public over the next 12 to 24 months. I mean, you can look at companies like Databricks. They were also in the news earlier today. It looks like they might be raising some money in a financing round that may extend their ability to stay private for a little longer. But they are one of the best AI companies that's still private, in my opinion. And I think you will ultimately see those kinds of companies in the public market in the short term.
All right, we'll see when that actually plays out. Doug, really appreciate your joining us today. Doug Clinton is founder and CEO of Intelligent Alpha. And Romain, there have been some headlines here of 13F filings where investment managers disclose their holdings of companies.
Yeah, we're taking a look. We talk about AMAT, of course, being one of the biggest decliners in the after-hours trade. Two that jumped out, though, are Pool Corp and Domino's Pizza. Those are actually two of your biggest movers, at least among large-cap stocks. And that's on the back of 13F filings coming out of Warren Buffett's Berkshire Hathaway. New positions in both of those companies, both for Pool Corp and Domino's. Domino's, the bigger position, about 3.7% now that they hold of that company. I think roughly about 1% of Pool Corp. And of course, there's been so much speculation about Berkshire's stake in Bank of America. Remember, it had been shedding a lot. We're now learning that as of the end of the third quarter, it held roughly about a 10% stake in Bank of America.
Although it should be noted that Apple is still the biggest holding in Berkshire Hathaway, about 26% of its assets. But, you know, Warren Buffett always talks about how he invests in what he understands. He understands companies that install pools. He understands pizza, and he understands Main Street banking, and he understands iPhones.
Also keep an eye on AST Space Mobile here. They just announced those new contracts that the street was waiting for, and the market reaction in the after-hours trade to the downside.
All right, coming up, from building EVs to powering AI data centers, we're going to talk to Mike Henry, the CEO of BHP, about the future of mining and metals to the global economy. This is The Close on Bloomberg. President-elect Donald Trump's transition team reportedly planning to kill the $7,500 consumer tax credit for purchases of electric vehicles. A big deal for many industries, including the metals and mining sector that help produce materials for EVs and other items. BHP, of course, the world's largest mining company. So here with us now is Mike Henry, its CEO. And this is just an example of some of the things that have changed in the wake of the election victory by Donald Trump. I'm curious whether your forecasts, your assumptions on global demand for copper, for iron ore, how they've changed in the past 2 months, because we got the big China stimulus announcements in October, kind of throughout October. And then, of course, in November, we heard about the election of Trump.
So, you know, the big picture for metals and minerals is that ongoing global population growth, ongoing urbanization, you know, as people aggregate in cities, taller buildings are more metals intensive. You've got billions of people around the world who are all aspiring to the same standards of living that we enjoy. Again, that's more metals and minerals intensive. So even outside of the decarbonization thematic, metals and minerals demand over the coming decades is going to grow strongly. We're very well positioned for that. Of course, in the short term, policy changes will have an impact on demand, but it tends to be at the margins for the commodities that BHP is producing. And our key commodities are iron ore, steel-making coal, copper, and potash, and we're quite confident about the outlook for demand for those.
Even in the short term, what kind of preparations are you making to kind of blunt the impact of protectionist measures that the incoming White House would make to reshape the operating environment for big companies?
And so again, you know, BHP doesn't tend to think about the world in the next quarter. It tends to be over the next quarter century. The investments that we make in new supply are decade, 2 decade, 3 decade long investments. And against that backdrop, we don't actually see the long-term trends in terms of growth for metals and minerals as having been impacted by near-term policy. Now, having said all of that, because of the assets that we hold, sitting at the low end of the cost curve, we generate more significant margins than others in the sector. We will be more resilient, even in the face of short-term perturbations in terms of policy and trade flows.
Well, I am curious about that, and I'm glad you kind of look long-term, because, I mean, BHP has always kind of had this reputation of kind of doing things for the future. The idea you're kind of producing the minerals and materials we need for these future endeavors. Let's talk about copper. And I also want to throw in nickel there. I know that's not really in your wheelhouse, but there's a demand out there that they're projecting. And I've seen some of the numbers on supply that just even going to 2030, 2035, some huge jumps, much bigger for nickel, but even for copper, the amount of tons that need to be supplied to this market to meet our needs is exponentially higher than what I think we're capable of producing right now.
Okay, so it's a great point, and there's a real compare and contrast there. So BHP is, or was, because we put our nickel operations into temporary suspension currently, but we were one of the world's biggest producers of nickel. That market has been disrupted by a lot of low-cost nickel supply coming out quite quickly from Indonesia. Copper, on the other hand, we're expecting, you know, between now and 2050, demand to grow by somewhere between 70% and 100%. And the new supply that needs to be brought onto that to meet that demand is becoming more difficult to find, more costly to develop, with more risks that need to be managed on the surface. And it's companies like BHP that are going to be best positioned to meet that demand because of our balance sheet, our scale, the technical capability we built in the organization. And but you're right. Investment is lagging. By our estimates, upwards of $250 billion required over the coming decade to meet the world's growth and demand for copper.
Do you have any sense here that there will be any sort of major new copper finds out there?
There will be, but they're becoming less frequent, and the new copper finds are tending to be deeper, smaller scale, and lower grade. But there will be, particularly with the advent of new technologies, there will be new copper finds. And even within the BHP portfolio, we had a pretty significant find in South Australia a few years back, a deposit called Oak Dam, where the application of latest technology, AI, to ground that had been looked over previously helped us to identify a new discovery.
Mike, I want to ask you about M&A because in May, Anglo American rebuffed your $75 billion offer. And last month, your chairman, Ken McKenzie, suggested Anglo had moved on and so has BHP. Is that the case? Clarify for us whether BHP is still interested in Anglo American.
So there's nothing really I can say beyond the statement that we issued after that, given the constraints that are placed by the takeover panel or takeover code in the UK.
So last month you visited South Africa. You were speaking with government officials and investors there. Some people interpreted that, though, as an effort to build support. Is that a fair read at all, or was...
So look, I saw the reporting in that regard. But we have to keep in mind that South Africa is one of the world's leading mining nations. BHP is the world's largest mining company by market capitalization. Of course, it makes sense for me as the CEO of BHP to be visiting South Africa periodically for so many reasons.
Do you have any misgivings about the structure of the original approach that you made to Anglo American?
No, look, in that transaction, we saw there being a real opportunity to create value for both their shareholders and BHP's shareholders. We went about that in a way that we thought was sensible, targeting the assets that we believe were most attractive and most on strategy for BHP. But there wasn't a meeting of the minds. But we're confident in the decisions that we took at that point in time, and we've shown the discipline that we've always committed to. We've been consistent over time in saying that we're willing to pursue M&A for the right assets and the right commodities where through BHP's ownership, we're able to create fresh value for BHP shareholders. But where that's not the case, then we'll be disciplined, and we're happy to step away from things.
Is the overall environment conducive for M&A right now? Do you expect it to be more conducive in 2025?
Look, it's hard to say in the very short term, but what I will say is, for all the reasons I mentioned earlier, which is that new deposits in certain key or critical minerals are becoming harder to find, more expensive to develop, and requiring more by way of capability to manage risk and technical capability. That suggests an aggregation to scale over time. And companies who are of scale, who have strong balance sheets like BHP and who have deep technical capability, those will be the companies that will win in the decades ahead and will be best positioned to supply the metals and minerals that the world needs.
One final question. You've been in this job now for almost 5 years?
5 years.
Coming in.
Yeah.
Your chairman, Ken McKenzie, recently gave an interview over there in Australia. He was talking about succession planning, not only for him, but also for you as well. Are you part of this?
Look, ultimately, it's a board decision. What I can say is we've made great progress over the past 5 years. We're operating in a more reliable fashion. Financial performance has been strong. We're positioned at the forefront in terms of being able to meet the world's needs for copper, potash, and continuing with very strong iron ore and steelmaking coal businesses. And there's lots more to get. In spite of all of that, there's so much more to play for, and I remain committed to that.
All right, Mike, we really appreciate you taking time. I know you're busy. Mike Henry here in the U.S., here in New York, the CEO of BHP. And of course, he has to navigate a changing world, and so too does the head of JPMorgan, Jamie Dimon, the CEO of JPMorgan, sitting down in Peru with our very own Lisa Abramowitz, weighing in on the 2024 election and the potential changes to come.
You had a big sea change that took place in that vote the other day, and some people were prepared and some weren't prepared. But I think the most important thing is whoever had been elected, and this is my belief, they are entering and could be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish him all the best. I think people try to help get through this. It could be a difficult thing with a lot of unknowns and uncertainties. And so policy is going to matter. And, of course, who runs the government will be determinative there.
President-elect Donald Trump sends a message to you that he respects you greatly, but you will not be part of the Trump administration as a Treasury Secretary, if that were something that were interesting to you.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years, and I'm not about ready to start.
I want to start by also talking about the response in markets in the U.S., which has very much been, this is going to be a pro-growth shock with companies that are going to be investing much more, deploying cash, aggressive in terms of U.S. expansion. Have you seen any signs that that's truly the case?
Well, yeah, you've already seen, the markets have responded quite well. And, I think America needs a growth strategy, so I literally applaud that. I think collaboration between government and business is the way to have growth. They've already spoken about a deregulatory environment. I want to point out, I'm not talking about just getting rid of regulations, but the regulatory environment in most countries has become stifling. And in a lot of countries, including Peru, it's why you're growing maybe at 2.5%, not 4 or 5. In America, it's why we've been growing at 2% for 20 years and maybe not 3. So I do think it's a reasonable thing to have that kind of reform. And that reform has to go deeper than just regulations, which can unleash capital, investment, and banking and stuff like that. It's got to be permitting. And all the related things that come with that, where people, you were just mentioning in mine that, someone bought that could do rare earths in the United States, it's 10 years, they haven't gotten their permits yet. I mean, it's a shame, and we're doing this to ourselves, and it's a mistake. So I applaud any government that says, I'm going to make government more efficient. And I think inefficient government is one of the reasons that people are frustrated. That why you have some populism, because they may blame, they may look at big companies, but they also know their government isn't spending their money wisely.
That was Bloomberg's Lisa Bromwitz speaking with JPMorgan CEO Jamie Dimon at the Apex CEO Summit in Peru. And Romain, you heard the chuckling and the laughter when Jamie Dimon said he hasn't had a boss, someone to report to in 25 years. He's not about to start now.
Yeah, funny, although I think the chairman and the board, the rest of the board might disagree with that, as well as
well, he is chairman of the board,
thousands of, well, he wasn't always, and of course all the thousands of shareholders that would also say that we're your boss too. But his point is well taken.
All right, let's move from CEOs of a financial company to a CEO of an entertainment company. Disney's latest earnings show that its continued dominance at the box office and at homes. It really highlighted that. Here's what the CFO, Hugh Johnson, over at Disney told Bloomberg about the company's streaming gains.
We feel optimistic about, as the industry is coming together, we're going to continue to both add subscribers, and in addition to that, because of the value we're delivering with the great IP and the great product that we're putting into this service, we'll be able to take pricing as well. And that combined with good cost management that we have in place in terms of good disciplines on that business, we feel very optimistic about where streaming is going for us.
Now, streaming, of course, has forced movie studios to be a lot more strategic about when to make films available for streaming, with more studios choosing to hold out longer before allowing them to be streamed. Case in point, last year's Barbenheimer craze. Remember that?
Vaguely.
When both Barbie and Oppenheimer took like 5 to 6 months
You couldn't escape it, Scarlet.
All right, there you go. And it may be the case for Glicked this year. That's when Gladiator 2 and Wicked hit the big screens next Friday. November 22nd, Glicked.
Glicked?
Yeah.
That's not quite as rolls off the tongue like Barbie.
Well, here in studio is someone who knows the value of releasing movies on the big screen, Richard Gelfond. He is CEO of IMax. Great to see you again, Richard.
Nice to see you, Scarlett and Brad.
What did you learn about Barbenheimer, that twin release of 2 big event movies that could be applied to something like Glicked for this year?
I don't like the Glicked thing.
Sorry. Yeah, thank you. Thank you.
Not going there.
Not a fan.
I think if you find movies that appeal to different audiences, you can play them at the same time, and each could find a really large audience. As you know, Barbie did well over $1 billion, and Oppenheimer did close to $1 billion, and audiences loved it and got people in a movie-going habit. I think the movies coming out this year are similarly complementary. So Gladiator is a big spectacle movie. Yes. We're going to show a lot of it in IMax on the IMax screen. It kind of looks incredible. It's an event. Wicked is musical, colorful, bright, lots of action, has real fan following because of the cast of it. And Moana is one of the most beloved animated features out there. So I think what makes it work is that it's a niche for everyone. If there were overlapping demographics, I think it'd be more challenging and they'd be more competitive.
So they have their own lanes, basically. But do some movies just lend themselves better to IMAX than others? I mean, you could argue that, yes, Oppenheimer or Gladiator 2 should be seen on an IMAX screen, but Barbie, maybe not as much, or Wicked, maybe not as much. It's a musical.
Yeah, I think one of the things we love about this coming up period is that we're not committed to just one of the movies, so we can play all of them in different amounts. Because we're a single screen, we don't have multiplexes. So we're going to lean very heavily into Gladiator on the opening weekend because of what we said, the scope and the scale and the experience.
The pageantry.
But I think Wicked's going to have a tremendous fan following, and I think the color of it and the music and
that'll be on IMAX too?
That'll be IMAX too.
Yep.
And Moana's going to be IMAX too the following weekend, Thanksgiving weekend. So I hate to say it, but in a way it's an embarrassment of riches, because also if one of them doesn't quite live up to the expectations, you're not out of luck. You can just switch your programming and go to some of the others.
Well, speaking of an embarrassment of riches, there was a lot of talk, of course, about the dearth of available content coming out, of course, the pandemic and then the writer's strike and the director's strike and everything else. That seems to have been resolved. Look ahead to next year. I mean, what's that slate looking like in terms of volume of productions that are going to come out, and more importantly, that are coming straight to the first to the theater?
Yeah, I think this period is really, and followed afterwards by Mufasa from Disney, is really the on-ramp.
That's the Lion King
for 20,
story,
right, the prequel, is the on-ramp for 2025. And 2025 has an incredible slate among the movies, and I apologize for leaving it, many off the list, are Avatar at the end of the year,
Mission Impossible, Superman,
F1. Formula One. We have very high expectations for this. I think 2 or 3 Marvel movies coming out this year. For certain kinds of movies which are very special to IMAX, we film them with IMAX cameras, and next year we have 14 films shot with IMAX cameras, which is twice as many as we've ever had before. And we've already gone, when we gave guidance on our last quarter call, we guided to $1.2 billion in box office for us for next year, and the best year we've ever had.
Is that because of an increase in traffic or an increase in ticket prices?
Traffic.
Okay.
Is $1.05 billion.
Gotcha.
Was the best we'd ever done, because it's just so packed. And it's early to talk about this, but it's a story people haven't really noticed. But 2016 includes Star Wars.
To 2026.
2026.
Yeah, okay,
Dating myself quickly.
Yeah, that's fine.
2026 includes Star Wars, again, a bunch of Marvel's, 2 Avengers movies, the new Chris Nolan movie. Dune 3 has been rumored to be coming out that year.
Have you ever met Chris Nolan? Do you talk to him? He's kind of a weird guy, right? Like he demands everything be like just perfect and these things. I mean, how much? In all seriousness, in all seriousness though, like how much conversation do you have with the directors, or at least with the studios, when they are getting ready to make these films to make sure that they do get funneled into IMAX?
Well, a lot. They work with us 2 years in advance. So Chris's movie in 26, we started talking to him about 6 months ago. And I know Chris for 25 years, and I consider him a friend. And by the way, he's a great person in addition to some of the...
And he's a friend. So can you do something for me?
Yes.
Because I love him. I love his movie. Tell him he's got to do something about the volume on those movies. Like,
loud?
No, it's the exact opposite. It's always too low. You can't hear people talking.
By the way,
he does that intentionally?
He does it intentionally.
I know.
Sorry to tell you that.
That's an opportunity then for you know?
But I want to tell you one quick story. He's such a good person and friend that the night before this year's Oscars, when he was up for Oppenheimer, we have a tradition of having dinner together. I said, look, this is your year, Chris. Go with your kids. Go with your mother. He said, nope, we've been doing it forever. We're going to do it again. So he's really a loyal friend.
Or superstitious.
I don't take it that way, but you can.
No, I don't mean it like that. We started this segment by talking about how there's so much devotion to being able to stream movies at home now. And I wonder whether, and this might be a dumb question, can IMAX ever be installed in home theaters? Is that something that, in 5 years' time, that maybe even next year, that can happen?
We thought about it years ago, but we have an alternative we have a couple of alternative technologies. One is called IMax Enhanced, where if you turn on Disney Plus and you go to the Marvel box, all of the Marvel films are shown with, it's called IMax Enhanced, which is a different aspect ratio. And we also have a subsidiary that improves the quality of streaming technology and also saves costs. So we figured other ways to participate in that revenue stream.
All right, Rich, great stuff. Got to leave it there. Rich Gelfond, he's the CEO over at IMax. And of course, he did talk about a big slate of movies this year, and that includes Wicked. And just yesterday, we had a chance to catch up with the CEO of Bloomingdale's, Olivier Braun, who has a very special relationship here with that franchise. Let's take a listen.
We had a pretty strong past few months, so I think we expect it to be going in the same direction. We're optimistic. We're optimistic because we have such a great campaign, we have such a great energy right now, so we have everything in our hands, great products, great collabs, etc. So we have everything to actually do great season.
What you couldn't say, they got won that shot. Scarlett and I were sitting right next to him, but it was like the land of Oz. They like tricked out the Bloomingdale's headquarters, which is right across the street from Bloomberg headquarters. It's like
There's
a
lot
Wicked
of green,
theme.
which is the same color as the witch's face. I've never actually seen Wicked, so everyone had to explain this to me. But now
and a lot of pink, and they had the big thing. Cynthia Erivo.
We didn't see Cynthia Rivio though.
Oh, I did. I was there last night. Scarlett, you went home early. You got to, I thought you were the party person here. But anyway, it was a great night,
day.
and of course, a lot of expectations for this movie opening. Of course, the same weekend as Gladiator 2. We'll be back in a moment. This is Bloomberg. All right, the Octagon returning to Madison Square Garden here in New York this weekend. UFC 309, the annual trip that Dana White makes here to the great city of New York. Everyone anticipating a big fight. Of course, John Jones on the head of that card. We had a chance to catch up with Dana White, the CEO of UFC. He talked a lot about the fight scheduled for this weekend. He talked a lot about his relationship with President-elect Donald Trump, and he talked a lot about expansion for the UFC.
Oh, the Sphere was amazing. As far as bucket list, I have things like we're going to do our first fight ever in Africa. We're going to do our first fight ever in Spain, opening up new territories and going back to places that we haven't been to in a while. For instance, I haven't been to Chicago in a long time. We're just talking about Chicago. Start hitting a lot of these cities that we haven't been to pre-COVID.
So you're a Vegas boy. It was kind of like a homecoming for you in many ways, going back home. MGM has said it will offer up T-Mobile Arena as part of an ownership bid to bring an NBA team to Vegas. So as an anchor tenant over at T-Mobile Arena, I'm curious what you think about having 3 sports companies under one roof in one building. Is that a good thing?
Well, it's fascinating because the NBA stuff has been thrown around, Vegas now for the last few years, and people are going to come in and build a new arena. Is MGM going to do it? Who's going to do it? I don't know. But one thing I can tell you, Vegas is a huge sports town now. I mean, when you really think about it, for years, sports weren't allowed to go to Vegas because of the gambling. Then they got over the whole gambling thing. Now every sport is in Vegas. And when you think about it, if you are a fan of a team, whether you're a fan of the Bulls or the Knicks or whoever, and they go play an away game, where are you going? You're going to a Vegas away game, no doubt about it. So it makes sense, and baseball will be there soon, basketball. It has truly become an amazing sports town.
And of course, you are still keeping tethered to, I guess, the more traditional sports markets. You're here in New York for UFC 309, which is taking place this weekend at Madison Square Gardens. Talk to us. I mean, you kind of only really come here once a year for the big UFC events. Right. Has there been any discussion about doing more events here, or is this just kind of enough?
Well, think about this. Yeah. This Saturday is the #2 biggest gate in the history of MSG. Yeah. So now the UFC holds #1, #2, #3, #4, #6, 7, and 9 of the top 10 biggest gates ever at MSG. So in the next couple of years, we'll have 10 of the top 10. Yeah. But MSG is always our end of the year big event. Yeah. I don't think that I would come more than once.
And it's bigger this year, obviously, with John Jones back in the fold. How are you handling him right now?
Yeah,
I've heard some things.
It's good. It's good. He's one of those guys that he's the greatest of all time, and never been beat.
Yeah.
In 16 years in the sport, which is unbelievable. And when he does show up to fight, it's special.
If you were to tell someone who's never watched the UFC about Saturday night's event, what would you tell them? What's the selling point?
You might not be the biggest fight fan in the world, but when you go to the UFC live, it's great on TV, it's fun. It is the greatest live sporting event you will ever see. The energy, the buzz in the arena is unbelievable. And obviously, when it happens at Madison Square Garden, it's even more special. You have to see a UFC fight.
Am I going to see potentially President Trump there? President-elect Trump?
You never know. He's a fan. He could possibly pop up.
He's been there before, right?
Oh, yeah. He's come to many, yeah. Actually, he's the one that when we first bought the company and venues didn't love the UFC back then, he opened up the Taj in New Jersey and said, we did our first couple of events there at the Taj. And he showed up for the first one and stayed till the last fight. That was when he became a fan.
I know you've been friends with him for a long time. Any plans to actually work for him in his new administration?
I want nothing to do with politics. No, I do not. No.
We mentioned the Sphere fight earlier. Potential media suitors, I believe, were at that event as well. I'm curious what kind of feedback they had for you on that.
Yeah. Well, the other thing is that UFC's rights are coming up now, and we'll end up either re-signing with ESPN or a new partner here in 25. And I have this philosophy, like when I grew up, we had Channel 3, Channel 5, and Channel 13, Channel 8 and 13, and then we had like 33 cable channels. When you think about this business and you think about what's the ceiling, the ceiling is 8 billion people. There's 8 billion people in the world, and I believe over the next 10 years, we'll see how this shakes out. Is it Amazon, YouTube, Disney? Who's it going to be that will be the Channel 3, Channel 5, Channel 8, and Channel 13 globally around the world? And like we were just talking about, as we continue to find new talent from all these different countries in every part of the world. We are the largest pay-per-view provider on earth. We're in over 1 billion homes worldwide.
Right.
And as we continue to grow and create new stars, the sport's only going to get bigger.
You dominate pay-per-view here, but do you see value in having, I guess, a permanent home with one of the streaming networks?
Yeah, I agree with you. I think that whoever we do the next deal with, we'll be with for 10 years.
Okay.
Yeah.
Yeah. Is there anyone you favor? Any company you favor?
I tell you this. We started on ESPN 7 years ago. We had a rocky relationship in the beginning. I couldn't be happier at ESPN. Okay. Literally, it's a great relationship. We work really well together. And I wouldn't mind staying with ESPN.
Are there any revenue streams that you haven't tapped into that you're looking to that, is on your bucket list for 2025, 2026? We're
going to start doing jiu-jitsu. Everything combat sports, our ticker symbol is TKO. Yeah. TKO will have everything. Boxing, slapping, jiu-jitsu, MMA.
That was Dana White, the CEO of the UFC. And of course, for more on the UFC, you can catch Emily Chang's interview with UFC's parent company, TKO, and Endeavor's CEO, Ari Emanuel, on the circuit. You've been to a UFC fight before, right?
Yeah, I've been to a couple of the UFC fights. I'm going to date myself. I went to some of those old MMA fights that they used to have, them out really out in some rural area in a barn.
Not at MSG,
because it couldn't get approved by any regulators. That was back in the early 90s.
You and Donald Trump.
But it's come a long way here. And it's, if you've never been to one, and I don't want to just sound like I'm just, sucking up to Dana. But when he says it is a spectacle to really be seen. Kind of like nothing that you've really seen. Not even better than NFL.
I've seen a cleaned up version in that it was featured in a Friends episode. That's about it. I know, dating myself.
All right, we're going to be back in a second with setting you up for what to watch over the next 24 hours. This is Bloomberg. All right, let's push ahead to what the markets will have their eye on over the next 24 hours, and we start tomorrow with earnings. Scarlett.
Yeah, Alibaba will be reporting and giving an update on its Singles Day performance, kind of its version of Black Friday. Of course, it faces a lot of competition from the likes of Temu as well as JD.com.
Interesting read here on maybe what's going on over there. Meanwhile, back here in the U.S., 8:30 a.m., a read on retail sales for the U.S. consumer.
Yeah, and my guess is consumers continue to spend. The economy is doing well in that regard. We also have industrial production at 9:15. That's been, a weak part of the U.S. economy.
Yeah, I mean, the manufacturing side of this has never really gotten out of the doldrums. Consumer spending is holding up. Of course, all things that Jay Powell is going to have to piece together as they try to decide what to do next. And of course, that brings us to your favorite portion of the show, Scarlet Fu. Fed Speak. Who you got?
Boston Fed President Susan Collins. She's going to be right here on Bloomberg, as well as New York Fed President John Williams will be speaking tomorrow. All
right, I've been interested to see what they have to say. And of course, we will bring you exactly what they have to say as soon as we get it. Scarlet and I will be back tomorrow right here on The Close. Stick around. Joe and Kaylee up next at the top of the hour right here on Bloomberg.